When starting a company, most founders pour their energy into the product, the team, and the market opportunity. Yet, one of the most important early decisions has nothing to do with code, design, or customers. It's the legal structure of the business, your incorporation type. This choice is more than paperwork. It defines the rules of the game you're playing. It affects your taxes, your personal liability, your ability to raise capital, and even your eventual exit. The wrong choice can create headaches, delays, and expensive restructuring down the road. The right choice, however, gives you a solid foundation to grow, attract investors, and scale with confidence. Choosing your incorporation type is about aligning your structure with your ambitions. If you want to build not just a product, but a business, this is a decision you cannot afford to treat lightly. Your incorporation type sets the legal foundation of your startup. It determines how ownership is structured, how profits are taxed, and how liability is distributed. It's like setting the rules of your board game. Once the rules are chosen, everything else follows them. The first impact is legal. Your structure defines whether your business is legally distinct from you as a person. If there's no separation, your personal assets are on the line if something goes wrong. If there is separation, your liability is limited to the business itself. The second impact is financial. Incorporation directly influences how much tax you pay, whether income passes through to your personal tax return, and how profits are distributed. These differences can make or break your cash flow in the early years. The third impact is investor requirements. Venture capitalists, angel investors, and institutional backers care deeply about structure. They want a model that makes it easy to issue equity, scale operations, and eventually exit. If your structure isn't investor friendly, raising money becomes far harder. The truth is that making the wrong choice early on can be costly. Restructuring later means legal fees, tax complications, and administrative headaches. It's always easier and cheaper to get it right from the start. The simplest path for many first time entrepreneurs is to start as a sole proprietorship or partnership. These structures are attractive because they're easy and cheap. With minimal paperwork, you can begin operating immediately. For freelancers, consultants, or side hustlers, this simplicity is appealing, but simplicity comes with major trade offs. In these models, there is no legal separation between you and your business. That means if the business takes on debt or gets sued, your personal assets, your home, your savings are at risk. Investment is another challenge. Sole proprietorships and partnerships make it nearly impossible to raise outside funding. Investors want equity, and these structures don't provide a clear mechanism to issue it. Growth is limited to what you can personally finance or borrow. These structures work fine for individuals selling their services, freelancers, designers, consultants, but they are rarely suitable for high growth startups. If your ambition is to scale quickly and attract investors, you'll quickly outgrow this setup. The next step up is the limited liability company, or LLC. For many small businesses, this is the perfect blend of simplicity and protection. The biggest advantage is liability protection. An LLC separates personal and business assets, shielding you from personal risk. If the company is sued or goes into debt, your liability is limited to your investment in the business. LLCs also provide flexible taxation. You can choose pass-through taxation, where profits flow directly to your personal tax return, avoiding corporate taxes. Or you can elect corporate taxation if that's more advantageous. This flexibility is a big plus for many entrepreneurs. Management is straightforward, with fewer formalities than a corporation. You don't need a board of directors or annual shareholder meetings. This makes it easier for small teams to manage without excessive administrative burden. But there are limits. While LLCs are excellent for small teams or bootstrapped ventures, They are not ideal for venture funding. Most venture capital firms strongly prefer corporations, especially Delaware C Corps, because of the clarity they provide for equity and governance. If your goal is to stay small and flexible, LLC works. But if your goal is to raise millions in venture funding, you'll likely need to convert later. When it comes to high growth startups, the C Corporation is the gold standard. If you plan to raise venture capital, build a complex equity structure, or eventually go public, this is the model investors expect. The first advantage is its VC friendly structure. C Corps are the default choice for institutional investors because they make it easy to issue stock, employee options, and multiple classes of shares. Complex capitalization tables are far simpler to manage under this structure. The second advantage is equity flexibility. You can reward employees with stock options, create preferred shares for investors, and structure ownership in ways that align incentives. This flexibility is critical in the startup world, where equity is both currency and motivation. The third advantage is the Delaware factor. Most venture backed startups incorporate in Delaware, regardless of where they are physically located. Delaware has well established business law, a specialized court system for corporate disputes, and investor familiarity. Incorporating in Delaware signals professionalism and preparedness. The downside is double taxation. Profits are taxed at the corporate level and again when distributed as dividends. However, startups rarely distribute dividends, they reinvest earnings into growth. And for founders and early employees, the Qualified Small Business Stock (QSBS) exemption offers significant tax savings on exit, offsetting double taxation concerns. For high growth startups, the C Corp is the default because it aligns with investor expectations, legal clarity, and scalability. While sole proprietorships, LLCs, and C Corps cover most scenarios, there are other structures worth mentioning. S corporations offer pass-through taxation while providing limited liability. However, they are restricted to 100 shareholders and cannot include foreign investors. These restrictions make them unattractive to venture capital firms, so they are rarely used by high-growth startups. B corporations are designed for businesses that balance profit with purpose. They appeal to founders who want to embed a social or environmental mission into their structure. They can attract impact investors, but they come with additional reporting requirements and are less common in traditional venture-backed ecosystems. Nonprofits are mission-driven entities designed for charitable, educational, or community purposes. They offer tax benefits, but are fundamentally incompatible with equity-driven startup growth models. Nonprofits cannot issue equity, making them unsuitable for venture-backed ambitions. While lease structures serve specific purposes, most high-growth startups default to the Delaware C Corp because it provides the right mix of investor friendliness, legal clarity, and scalability. Choosing the right incorporation type is one of the most strategic early decisions a founder makes. It shapes your legal protections, your tax obligations, your fundraising potential, and even your exit options. Sole proprietorships and partnerships offer simplicity but little protection or scalability. LLCs provide flexibility and liability protection, but fall short for venture-backed growth. C Corps, especially Delaware C Corps, have become the gold standard for startups seeking to raise capital and scale globally. Other structures like S Corps, B Corps, and nonprofits serve specialized purposes, but rarely fit the trajectory of high-growth tech startups. The key lesson is this: your incorporation type must match your ambitions. If you're freelancing, choose simplicity. If you're building a small, steady business, LLC may be perfect. But if you're chasing venture funding and global scale, start with a Delaware C Corp from day one. Getting it right early saves money, builds trust with investors, and sets the stage for sustainable growth. The final takeaway is that incorporation is not just legal paperwork. It is the foundation of your business model. Build it thoughtfully, and everything else, from fundraising to hiring to scaling, becomes easier.